Okay, assuming you've seen the video on how to calculate depreciation, we're now going to look at how to account for depreciation, or how to do the double entry. So we have an account called the provision for depreciation, which essentially is accumulated or total depreciation. And we need to use that. Okay, so you can look at it as accumulated or total depreciation. So the business has decided to use a policy of depreciation of 20% diminishing or reduced balance, and the original cost is 100,000 of the asset. Then we're going to do the depreciation, account for the depreciation based on those numbers. But it could be any policy, could be straight line method, and it could be any percentage, but we're using that one in this case. So after calculating depreciation, we discover, so if you do 20% of the 100,000, that in year one, the depreciation will be 20,000. And now this is assuming we buy the asset at the beginning of the year and there's no disposals or additions or revaluations. But if we had the £100,000 non-current asset from the beginning of the year, we depreciated 20%, first year's depreciation charge will be 20,000. And how do we account for that? Well, we're going to debit the depreciation expense account, because depreciation is the loss in value, loss, cost or expense, and we know from our double entry rules that we debit expense accounts. Hopefully you know that by now. So if we're debiting this, we're going to credit the provision for depreciation account. Now we could reference the other account here just by putting a narrative that this goes to the statement of profit and loss or the income statement, and in this case is going to the provision for depreciation account. Okay, so in year one, that's what we do. And this account, the expense account, will provide the number that we need that goes in the statement of profit and loss or the income statement. So that's the expense for depreciation. Now this account is for accumulating all the depreciations for each year. Now if that's the only entry in this year, we balance the account off. Hopefully you've seen the video on how to balance accounts. And so we look at putting the total into the totals at the end of the year. So assuming the first year of ownership is 2022 and we buy the asset at the beginning of that year, so we've depreciated for one full year. And then the total on this side as well, we use the larger total on both sides. We work out the missing number here, 20,000, and that's the balance on this account that we are going to carry down into any future year. And that then is brought down into the opposite side underneath the totals, and we, in year two, we bring down a total or accumulated depreciation of 20,000. Now, then in year two, we are using our calculation method, whichever one we've decided to use. In this case, it's 20% diminishing or reduced balance. If we use that method, then that means we have to do 20% of the net book value, the remaining value or diminished value of the asset. So the cost was 100,000. It lost 20,000 in value in year one. The diminished value or the net book value is 80,000. So if we did 20% of the 80,000, the second year's depreciation is 16,000. And then we account for that in exactly the same way. We account for the 16 as the loss or the expense or the cost of depreciation that goes into the statement of profit and loss and the income statement, and that's from that account. So we've debited this. We're going to credit again the provision account. So this year's income statement or statement of profit and loss charge is 16,000, which essentially adds to the 20 that we started with. That's why it's accumulating the depreciation or total depreciation, and that's us accounting for the depreciation in year two. We debited that account, credited this account. We always have an equal credit for a debit. Nothing else happens, so we total up the account for that year, and the total is 36. Remember, totals are not your balance to carry down or balance to bring down. They are separate numbers. We work out the missing number here, which is 36 on this side, and that's the balance or value at the end of the year to carry down. And we bring that down here on the other side, underneath the totals, as our balance brought down, obviously at the start of the third year, and that's same as the end of the second year. Okay, and then so we do it one more time. Now the diminished value or reduced value now, because we're doing reduced balance or diminishing value depreciation, the reduced balance now of the asset would be, well, if we put it in here, so we've got a cost of 100 and we've got total depreciation at this stage of 36. So that means that our reduced balance now, or value, or net book value, at this point, taking that 36 into account, would be 64,000. So the value now of the asset is 64, the net book value, and since we are doing a diminishing or reduced balance, we are working out the 20% on the net book value of the figure of that. Okay, so then 20% of that figure is 12,800, and so we account for that in exactly the same way again. 12,800 is the depreciation expense or loss in the value. A loss is an expense or a cost, and that goes into the expense account for depreciation. This is not the expense account, this is total depreciation or accumulated depreciation account. So it goes into the expense account, so we're supposed to debit from your dead click rules. So we debit this account and we credit this account to accumulate further again the depreciation. So this is this year's statement of profit and loss or income statement charge for the year. That adds to the brought down or total depreciation so far, and including year 3, we can total this up. That comes to 48,800, 48,800, and the missing number this side both adds up to that, this side doesn't. There's a missing number there, 48,800, and that is the balance to carry into next year. And the balance then brought down at the start of the following year is 48,800 on the accumulated depreciation account. And then the value at the end of all of this, at the end of the third year, so we've got year 1, year 2, year 3, at the end of that year, if we were to do a statement of financial position extract, the cost is still and always will be 100. The total depreciation is 48,800, and we take that off, and then the net book value at the end of all of this, at the end of 3 years, would be 51,200, and that would go in the statement of financial position. Okay, so that's how you account for depreciation. This is the provisional accumulated depreciation account, and you can go to my longer videos in the link for a more thorough coverage of all this.